so I just gotta get the music or set. We can start talking. We'll get it.
Well, welcome to the February 7th meeting of the North County Estate Planning Council, San Diego. I think we have a great presentation today from three what I call real estate experts on what's going on in the economy here in San Diego and California and beyond. A few quick announcements. Obviously, we're meeting in person since October 2021, and obviously the turnout is kind of speaks for itself. So as far as I'm concerned, it's great to see you all and welcome back. Couple things to note as we get the video to come up. Our next meeting is going to be March 7th, and this is kind of our annual what the estate planners could learn from the estate litigators and estate administrators. It's going to be a panel led by Dawn Hall Canine of Canine and Booth and Bill Guthrie of Northern Trust, who we're going to add a judge, a probate court judge to the mix. So that'll be coming up on March 7th, and it's certainly going to be revolving around how to head off the problems at the drafting stage and maybe cut them out of the work. Since we've ready to go, I want to introduce J. Robinson-Duff and Dina Carter of First American Trust, our sponsor for today's meeting, and welcome and take it from here.
Good morning. My name is J. Robinson-Duff. I work at First American Trust. Briefly, we do estate settlement, ongoing trust administration, and wealth management with a specialty in real estate. That's the highlight. We had the slides up a second ago. All right, here we go. So we are a bank. We're a limited charter bank, so we don't do everything. We just do wealth management, and that's what we use our banking charter for. So that means we will report up to the Department of the Treasury. As you can see, $3.9 billion, and then 1.9. Yeah, you can read. We have offices in California, Nevada, Tennessee, and Washington. Nevada, depending on who you are. We have a Nevada trust company because Nevada has special trust provisions that we're able to use that we cannot use or have here in California. So we find a lot of our wealthy clients want to have those type of trusts, which are dynasty trusts, directed trusts, and NINGs. So trusts of that nature. We can flip to the next slide, please. So wonderful picture of me. And then we have here the revocable trust, irrevocable, administrative. So that's just estate settlement. Charitable trust, base banning, but charitable trust, as you can think of. Special needs, life insurance trust. I will say a life insurance trust is special, so we do like to see assets outside of the trust as well. And then asset protection trust, and that's through Nevada. We do sole trustee. We also are co-trustee in a number of situations. That's our trustee and the agent for trustee. So those are all the different ways we can serve. And again, liquid investments. You probably know First American from our real estate, right? First American, as I always get told, oh, I say First American, they go, your title. No, I'm trust. You know, real estate's a big part of what we do. Closely held entities, debt collections, and oil and gas. And if you want to jump to the next slide, here is just to give you this is from title. They were going to have a rep here today, but he decided to go skiing instead. I'm sorry, Bill. So one of the things that we do is property profiles. So if you are looking for, how is that property currently titled? We pull a property profile. And then there are conditional title of guarantee, claim of guarantee. So these are not full title guarantees, but they are more limited. And if someone has an interest in this, you can grab me later and I can talk to you about it. And then next slide, please. First American Exchange, one of the largest 1031 exchange facilitators in the country is what we have. So there's a number of items, as you're well aware, that need to be accomplished for qualification. And we obviously follow all those. We have people that help you with it. We go to the next slide. Thank you. And Anthony Aloso is our regional manager. He, again, Bill, maybe 7:30 is a little early for Anthony. So he is the individual that you contact. So if you're doing exchanges and this is something you want to look at, he's the guy that you should really talk to with his expertise. For me, that's it. Dina, you want to add anything?
I do what Jay does. So. I guess it means I need to go sit down.
I got we both made.
Okay.
Thank you very much, Bill.
So that was Dina Carter, who's new to First American and a great supporter of the council as well as the firm. I want to bring up John Fleming and Paramount Property Tax Appeal. Interesting firm. What they're after is, of course, how to minimize your assessed values, and that's where their profession comes in. John.
Great, thanks very much. It's great to see everyone this morning. Before I bring up Wes Nichols, the owner and CEO of Paramount, I'll tell you a quick story. I've known Wes for about 15 years, and it was around 2009 when I was serving as a court-appointed receiver on an apartment complex in El Cajon. I was chatting with Wes, and he knew the situation. He knew that it was a distressed asset. He says, John, you should probably really be appealing the property taxes on that apartment complex. I said, what? He says, the market value of that property has probably gone down and the taxes are too high. I can appeal for you, save the owner a bunch of money. I said, does it cost any money up front, Wes? He says, no cost. We work on contingency. We take a piece of the savings. I said, go, knock yourself out, see if you can save some money. Several months later, he calls me up and he says, well, John, I won the appeal, lower the property taxes on that apartment complex in El Cajon. I said, great. You'll be getting a refund from the county assessor, and then I'll send you my invoice. Several years pass, and I keep in touch with Wes, and I know that his business is doing well. It's growing, and he's building and doing a lot of appeals. And it was about 5 years ago when he invited me to come and work for him and do business development for the company, which I knew was growing, but I didn't really know how much. So now, 15 years in business, the company's done over 10,000 appeals throughout California. Anything from a condo to office buildings to shopping centers, industrial, you name it, any type of property. The company's done an appeal on it. Currently doing about $20 billion in assessed appeals on assessed values in California. Got a staff of 20 people here in San Diego. We just opened an office in Denver, opening an office in Albuquerque, New Mexico. So the company's doing very, very well. Now, you may be asking yourself the question, how could someone build a company of tax appeal here in California where seemingly property values just do nothing but go up? And we have Prop 13 where 2% increase per year. How could somebody do that? Well, I'm going to have Wes Nichols answer that question for you. So please welcome Wes Nichols, the owner of Paramount.
Thank you. I know I don't have much time, so I'm gonna just leave you with this. Here's why if you're an estate attorney or working in the trust and estate realm, you need to have someone like me on speed dial, because oftentimes when you are working on an asset or a trust or a portfolio, you focus on how the IRS is going to treat certain transactions. But one of the things that gets missed or does not get really looked at is how the county assessor is going to treat what you're doing. And our firm, we can help consult on what the county assessor might or could do, what the law is, and different tactics or ways to avoid reassessment or mitigate it in some fashions. The other thing is oftentimes we know that what you're going to do is going to trigger what we call a change in ownership or a reassessable event. And so oftentimes the assessor, they see a sale, they have a transfer, they have to determine what the base value is, but they have no sale price. They don't have any information about the property. And so they literally back of the napkin, do a quick appraisal on it, evaluation, turn it in, and no one really knows if it's right or wrong. Oftentimes clients will use an appraisal that they had done for the estate to kind of look at it and see if it's correct. The problem with that is those are appraisals that were done typically on a lease fee basis, not on a fee simple unencumbered basis. And property tax world, it's a different valuation. So we've had a lot of success in reviewing and getting those reduced, what the assessor enrolls. The other thing that we're doing a lot of is the preliminary change in ownership report. There's a video I can send you guys where I break down all the details. A lot of things that include intangibles such as hotels or anything with a business value. A lot of times those aren't being reported, or oftentimes we see people give too much information on the P-Corps. And so it's strategically figuring out how to go about filling that out. Another thing that we're doing a lot of is new construction. So if you're a developer, any kind of new construction, the assessor usually gets that wrong. And then of course, decline in value property. So in 2021, we were real busy doing hotels, retail, office. Now that has switched more to office. However, with the interest rates being up, dramatically up, cap rates are going up. So we're seeing also opportunities on all assets across the board. We haven't really started seeing it on homes yet. Again, we mostly track large homes in Rancho Santa Fe, but we anticipate those coming in the near future. But at the end of the day, here's what we do well. I try to explain is we're left brain attorneys, right brain appraisers, and we take the two together and we know how to fight and litigate in property taxes. And that's all we do. So we know the assessors, we know how they're going to fight, what they're going to use against you, and more importantly, we know how to win. So thank you.
Wes, John, thank you so very much. I probably learned a little bit more that I didn't realize that you all took care of. Real quickly, there's a bowl on the table where you checked in that you can put your business card in. This is for our trifectas that Pete Tentler over here is the master networker of and an organizer. He will match you up with 2 or 3 people not in the same industry. So it's a good way to get together for lunch, coffee, a hike, or what have you, where you can get to develop that deeper relationship. So certainly put your card in there and Pete will take care of the rest. Without any further ado, I want to introduce Doug Wilson, Douglas Wilson Companies. You all know Doug, he's been a regular member here for some time. I'm going to let him introduce our other panelists, Nathan Moeder and Brett Albrecht. But Doug is, of course, chairman and CEO of Douglas Wilson Companies. He brings nearly 35 years of experience of problem resolution, development, and real estate management for his company's clients. He's added in recent years kind of legacy real estate planning. And so he adds a lot to this discussion. And without any further ado, Doug Wilson, and he'll introduce the other members.
Thank you.
Good morning. Give me just a quick moment, if you would. So, I was reflecting and driving up here, what a delight it is to be here again. We've done this a few times. And I've always enjoyed it, and I've always had a great interactive opportunity to share some of our thoughts and observations about working with families and dealing with real estate issues with respect to those families. But today it's a little bit different. And today I am joined first of all by two wonderful colleagues. And I'm going to let them introduce themselves before their segment, because we're each going to have, as a point of structure, we're really going to have three different segments. And we could do the next slide. That's our pictures. That's very flattering, but that high school picture took a while to find. But anyway, the next slide, please. But anyway, what we're going to do is really have, as a matter of introduction, the intent here is to have this be applicable to all of you sitting in this room that are dealing with families and clients and issues. But instead, and we always want to have the context of what we're trying to get to and how this impacts families, clients, and their issues in the real estate market. But this morning, we're going to talk about the world of cycles, distress, reality, balance, and how all of these things periodically affect markets, how I built a career over many decades based upon navigating those cycles. But I'm joined in three segments by two wonderful colleagues. Nathan Moeder is a principal at London Moeder. Nathan is I'm going to allow each of them to introduce themselves in a little more detail, but Nathan is very well known in this market with his partner, Gary London, for market analysis insight. He teaches at UCSD. He is someone we've used recently on a very significant assignment. He is just the highest caliber player in that market. And I think you'll find his discussions with a particular focus on housing that'll be very timely and top of mind for many of you. Brett Albrecht, I've only gotten to know Brett over the last year or so, and it's been a pleasure because he works with John Kramer. He runs Kramer Land Company, which is a remarkable family office with a remarkable and unique story. And he brings some real discipline and sophistication to head that enterprise. And he'll be discussing some of these ground level observations on what he's seeing running this family office, what he's seeing in the capital markets, what he's seeing, what a broker's saying, what are the different asset classes dealing with today, what are those challenges, as we clearly are in a real estate correction, whether people want to believe it or not. We have been in this for the last 6 to 9 months, and it's going to continue for a while. So this is not a doom and gloom. We want this to be fun as it can be to navigate the reality of these markets, but we want it to be learning as well. So let's go to the next slide. And I really wanted to, so now we'll talk about market cycles and market trends and the insight. And this is really what I'm going to focus on. Next slide, please. So I am best known to many here probably as a developer. I moved here in 1983 at the age of 33, developed Symphony Towers. It was a hell of an undertaking. I was pretty young. Fortunately, I had a mentor partner, 13 years older. I was too young to know fears, so I thought everybody built that. But while building that project, I saw all my friends in Colorado, where I went to college, going broke because that market was seriously impacted in the 80s by the collapse of the energy markets. And so I learned about here, talking to the Chamber of Commerce, giving the Symphony Hall to the Fox Theater to the Symphony, pre-leasing the building to Price Waterhouse, Gibson Dunn, AT&T, and talking to my friends back home who are going broke. And so I learned about cycles in a meaningful, powerful, grown-up way. So I then crafted a business model for Douglas Wilson to navigate bad times, not just good times. I observed that a lot of developers just think the sun will always shine. That wasn't the reality that I observed. And so I started a niche to do workouts with banks, financial institutions, to step in as a fiduciary, as a receiver and a trustee, and grew that into the litany of different asset classes, eventually expanding out all over the country. And in these ensuing 33 years since I started that business, you know, we've been involved in over 1,000 projects sprinkled around the country, involving billions of assets in every conceivable asset class. So what has that given us? Perspective. It's given us perspective in real life dealing with challenges in the market. It's also given us perspective in understanding that cycles are powerful, inevitable, and unpredictable. And it's naive to think that this is, quote, a new paradigm and it'll never happen here. And so we're going to talk today a little bit about where we stand in this particular cycle from my observation. And then we're going to have an interactive discussion afterwards with the three of us answering your questions as well. How did I really, next slide, please. So part of our strategy through the years, I'm sorry. Pardon me, I see where we are now. No, you're good. You're good. It's just me. Anyway, so as a part of the platform with Douglas Wilson Companies, we've evolved as we've always kind of followed the money. Where the opportunities is once we establish our ability to develop all these projects, and we've done about $1 billion downtown over in today's value of numerous projects, how to take over broken problem deals at every jurisdiction as a fiduciary, because as a receiver, I work for the court. So we're not a predatory developer. How do we integrate that to be in this room and give us the credentials to be in this room? And Bill so well stated that about 5 years ago, we started our legacy asset management platform, which was really an integration of dealing with all of you professionals in this room collaboratively with these families you're dealing with, handing down complex real estate to subsequent generations and all of those challenges, which are many, as we all know. And I think they're going to even be multiplied as we go through some of these challenges we're seeing today. Next slide, please. So the real motto that I've always said in how I've been able to, with the help of a wonderful team through all the years, because I've always relied upon finding very gifted people. I've never had a business class, so I had to find really smart, capable people, let them do their jobs. But I was the one to say, where's the money? Who's got the capital today? Who's providing financing, who's providing debt and equity in these different market cycles. And so I think it's important that we talk for a moment about this cycle, which really started with the great financial, recovery, the recession we had, now it's many, many years ago. But when that occurred, a few things happened. First of all, Dodd-Frank was entered into. So there was a regulation that really precluded the bigger banks from lending. B of A would give you money if you didn't really need it. But, so who filled that void? If those big banks were there, you obviously had, regional banks who would do some of that. But Wall Street once again stepped in very entrepreneurially, and they created all these loan funds. Some were very large, sophisticated, Starwood, Blackstone, others as sponsors. Through the years, they didn't create 1 or 2 or 10 or 100, but 1,000 of them. And that has aggregated over these ensuing 10, 12 years, where we've had more capital in the markets, and Brett can talk to this with real insight, than we've ever seen. The massive amount of liquidity, we've always talked about that. But most of this capital is unregulated. It's not controlled by banks. It's unregulated. It's been very good at getting money out, but now we're finding it's going to be some challenges, and how do they unwind some of these problems? Because what has happened is, even though we've had, we had all this money, capital flooding the market, we also had an artificially low interest rate environment. Because although previously in cycles, the banks were told, mark your assets to market. In other words, write them down. If you think they're worth 10 million, they're on the books at 10, they're worth 5, take the hit now. But since the GFC, it was extend and pretend. We're going to hide all these projects with problems. We're going to trickle them out. We're going to keep interest rates remarkably low. And so that environment really existed and evolved over these ensuing 10, 12 years. And now what we're finding, next slide. So now what we're finding is that if you look at this list, you can see the whole litany I went through as far as, over the time and what happened, because we had the pandemic to today, we had 5 or 6. And then when the pandemic happened, actually an interesting thing happened because we all in the workout business thought there'd be problems that would be overwhelming. But in fact, there was an era of forbearance. Every lender, everybody was told to forbear their loans. In other words, don't enforce your remedies, allow you to use interest reserves. And that was a blanket forbearance that existed in all of these real estate markets. I don't care what your asset class was. And so then you fast forward through the pandemic, and there was 5 or 6 trillion additional dollars from the government funneled into the marketplaces. That was a liquidity event on top of these loan funds that we'd never seen before. And then lo and behold, in 2021, after the pandemic started to unwind, it was a feeding frenzy. I mean, we had cap rates under 3% for self-storage, no credit. And we saw these values. That was the most robust year in the history of commercial real estate, 2021. However, what happened last spring, the pause button was pressed. The pause button was pressed. And so we now had to deal with, people had to deal with some issues that they had never confronted before. The reality in 2022 is that we had the combination of cost increase. They were up to 35% in the construction sector. We had supply chain issues that were leading to delays in projects. We then had interest rates that started to adjust because things were so frosty last spring. So the confluence of all of these issues led to a lot of projects because the capital backed away at that point. The underwriting standards changed, the loan to values changed. And so if you have loans that were coming due, which is what we're facing now and into the foreseeable future, there are a lot of challenges. There are a lot of liquidity challenges that you're going to be dealing with. So, you know, we are in the middle of a bit of an unknown territory right now. And I want to be quick to say, this is not Armageddon. I'm not saying that at all. This is not the RTC. This is not a collapse at all. This is not what's happening today, but there are some realistic challenges they will all have to deal with. And as with respect to the families and everyone we're consulting and advising, you're just best to learn from these situations, best to look for the future, best to learn from the lessons of the past and order some discipline and to pay attention to your tenants, the credit worthiness, existing leases, new leases, you know, preservation of entitlements, preservation of permits. If you have capital events coming up, especially debt coming up, be aware that the fact that you're not going to get as much money on the refinance as you once were. And so what we are seeing, because I've always joked that we're a bit of a canary in the coal mine because we have these 200 institutional relationships. The phone rings when we see problems. So in concluding as to some of the asset classes that we're seeing, it's really the next slide, is we are seeing office as being the most challenged asset class. There's no question about it. Right now, no one knows where these values are, and everybody's talking about it. We have been approached since the first of the year on over 2.5 million feet of prospective office projects that are upside down. In some of these, the owner currently has no equity because the leasing, you know, maybe there's one case in particular, a big office building back east, 500,000 feet, 60% leased, institutional owner, non-recourse, big loan, $180 million. The owner says, we're not going to put in any more money. So they want to mail the keys to the lender. The lender doesn't want the asset. And so, well, they said, we don't want to own this thing. And so what do? They probably put a receiver in like us, look after the asset, perhaps sell it through a sale. I'm saying so hotels, back to office is really kind of the eye of the storm because there's a lot of challenges. They talked about adaptive reuse for other issues like conversion to residential that might apply in some areas, but as a holistic solution, not so much. And so, you know, these other asset classes, industrial strong, multifamily strong, they all have certain challenges. And we have hospitality, which has rebounded in a significant way, at least at the extreme ends of the market, being the most expensive to the least expensive. But there are a lot of challenges in between. So with that, I'm going to just conclude and set the table and allow Nathan to come up and to spend a few minutes to really talk about his observations more on a factual basis of what he's seeing in the market. But what, again, I really want to make sure that afterwards we can have an exchange and how we can turn this into take this knowledge and turn it into a positive benefit, and how you can all deal with your clients by being, instead of being reactive, actually anticipating these situations, looking to the future and not just being passive. So with those thoughts, Nathan, please.
Good morning, everyone. I have a little bit of a problem. My daughter for many years thought her last name was Moeder because they would keep hearing Moeder. Actually, it's Nathan Mader and it's London Mader Advisors. I should change my name and just forget it, but if you want to be, yeah, I know. I thought you knew it. Oh, yeah, it was Michelle. So London Mader Advisors is a real estate consultancy. We are real estate economics, so market analysis, financial analysis for real estate projects, all types of projects, hotels, office, raw land. I've done boat marinas, freeway studies, anything that's a real estate land use, we analyze. As far as trusts and families, a lot of our work around there is looking at a portfolio and determining what's the value beyond what exists today? Is there redevelopment potential? Is there repositioning potential? So when you're negotiating these assets, or if you're deciding to divvy up the assets or the trust wants to break up, you know what the true prospective value is. So we do a lot of that type of analysis. Same kind of thing in divorce cases. We do divorce cases. A lot of litigation work when you're trying to value what's the potential value and the financial options for these portfolios too. You might need to give a certain amount of capital to one project. Where does it come from? What's going to be the return on that money? Is that the best interest of the overall valuation of the portfolio? So we see a lot of things. Essentially, we're economists. So what you'll hear from me today is just kind of our picture of San Diego, what's going on in the market, and we'll go from there. So if you can, I'll just bottom line it right now and we'll just get it out of the way. Housing prices have fallen about 9% in San Diego. If you read the papers, they're calling for another 10 to 15% in San Diego. I'll be surprised if we're here next year and it's fallen another 10%. I think we've pretty much hit that bottom. We may go down a little bit more over the next couple months. I could see us maybe being 5% down, but I don't believe it's another fall of 15%. So we'll just get that out and I'll tell some more through these slides as we carry on. What I want to talk about first, slide please, is just, we'll talk about residential. And it's one of my favorite subjects because when we look at San Diego and especially the state of California, everything comes down to residential. Our economy, which is driven by jobs, is based on the ability to house people to live in this state. So I want to show you what's going on with the residential market. This first chart, and I know a lot of you can't see it. I think there's handouts, so I'll just talk big picture numbers. This first chart is we need about 180,000 housing units in the state of California every single year just to keep up with population growth and how much housing we need to house those jobs. These bars up through 2021, you can see we've fallen well short of that. The last time we were building 180,000 housing units was prior to the financial crisis in 2008. The yellow would be multifamily and the blue lines are single family homes. So what you can notice here is what's fallen off since the financial crisis in 2008 is we're not building single family homes. So what does that mean for our state and for our region? Next slide, please. This chart shows, so state of California does a massive forecast and then they say, LA, you have to build so many units. San Diego, you have to build so many. San Francisco, you have to build so many. So here's the progress reports. We have housing elements and they're updated every 6 years or every 8 years. This is the last housing element. So this is how we actually, how much we've built in the last 6 years in each of these metropolitans. So you've got San Diego County, Orange County, there's LA Bay Area, Sacramento. The green is how much we actually built. The yellow is what the shortfall is. So in San Diego County, we've built about 60% of what we needed in the last 6 and 8 years. And in LA County, it's even worse. We're building about half of what we need in LA County. The markets that have done pretty okay, Sacramento. Sacramento is tons of suburban government. And so they've done all right. And if you could click the button, please. Got some more statistics here. You could click the next one too. And I just got some quotes. This is just our typical slides, but Joe Calkin, who's out of Chapman University, many years ago said, everybody should look at California to see what not to do. And I really agree with that because of all the constraints. I mean, real estate, especially in California, is about redistribution. Every time a real estate project comes up, let's talk about affordable housing. Let's talk about what we can do for the environment. Let's talk about, prevailing wage. It's all about redistributing versus actually building something. And that's the challenge. And that's why we have this slow growth to development. Next slide, please. What this chart shows is on the left side is what San Diego County built in 2012 to 2020. So that's 8 years. In green, we built 60% of the housing that we needed. This is our latest round of housing elements, and we're doing about the same. We're still building about 60% of what we need in San Diego. So it's not getting any better. That's the point of this. Next slide, please. Just an overview of what happened is many years ago, state of California, we decided to no more building in the backcountry. That's fine, however you feel about it. What this chart shows on the left is all the purple and the blue is where our plan was to actually build and put our housing and put our jobs. The chart on the right is you can see the blue and the purple starts to disappear because what we've done is we've shut off any remaining land, and we're going to focus now on that key term that everybody's heard is infill. Everything's going to be infilled. We no longer want to build out in Fallbrook or anywhere up the I-15 corridor. Everything has to be built in San Diego. A lot of that has to do with greenhouse gases and keeping cars off the freeway. What's remarkable though in our planning, which is a big fault in the state, is you look at greenhouse gases. And if you have a housing unit in Fallbrook, they count how many miles you have to drive to center San Diego. So that's a lot of greenhouse gas. But you don't have to count the greenhouse gases that are outside your geographical border. So while we have 100,000 people driving every day from Temecula, we don't count those gases. We don't have to. We're not allowed to. So we're going to stop development in Fallbrook and the I-15 in Escondido because it's too far away in San Diego. But when you look at our forecast, we're actually dependent on another 60,000 jobs in San Diego of people that will live in Temecula and drive here over the next 20 years. But we don't have to count those greenhouse gases because it's outside our boundary. That's our planning for us. Next slide, please. So we are doing a huge housing bet in California. And this is a slide for San Diego, but it's pretty typical when you look at the geographical regions along the coast. So San Diego, Orange County, LA, and further up. Historically, the lines to the left is every decade. So I think I go back to the I can't see, that's blurry, 60s. So maybe 60s, 70s, 50s, 60s, 70s. Okay. So the numbers in green is how much we've built in single family homes, the percentage of single family home development. And that red line is traditionally, for all of history, 60% of what we build is single family homes. Going forward, and these are San Diego numbers, but it's also indicative of the other coastal markets, the majority of our growth is going to be multifamily. Look at the percentages though, 78% will be multifamily, then 92, then 97. So what essentially we're doing is we're betting that if traditionally 60% of the homes, and most of the people want single family homes and they don't exist anymore, in the future, if you want one, 9 out of 10 who would want one won't be able to get one. So where do they live? Only 1 out of 10 people who want one will get that home. So will they accept multifamily? I think that's the biggest challenge in our region, and I have some other slides on this right now. It affects a lot of our recruiting in San Diego as well. The number one concern of employers, and we've done this for the Regional Chamber of Commerce a couple of years ago. We worked with another BW research group, interviewed a lot of the employers in San Diego. The number one concern is finding attainable housing for their employees. That's the number one concern, not all the tax laws and business laws and all that kind of stuff with the state. It's finding employees. Next question or slide, please. So a little bit on interest rates. I also teach at UCSD, and everybody asks what's the Fed? I hear about the Fed rate, and I say, don't pay attention to the Fed rate. I never pay attention to the Fed rate. When I was in economic schools, my professors told me not to do that, and I figured out why, and I saw why, because the Fed's going to do what they want. But that doesn't affect the cost of mortgages. What we're following is T-bills. Okay, so that's what we're all looking at and we're familiar with. I show this chart because in all of these black boxes, what you see is the yellow line or gold line is where the Fed started to increase the discount rate. And sometimes it was pretty drastic. But if you look at what happened to the treasuries in blue and mortgages in green, sometimes nothing really happened. So leading up to the financial crisis, that middle box there, you can see the Fed really went on a spree there in increases, but nothing really happened to the treasuries. They went up a little bit. And then this last time prior to COVID, they started to increase the rates, nothing happened. And so now currently everything spikes. Well, I think everything spiked and treasury bills spiked because it was a reaction of the global institutions, that gajillion dollars of money all throughout the world saying, whoa, hang on, America, let's see if we can get inflation under control. We've already seen treasury bills drop again. So it was above 4%. Now it's at like 3.5, 3.6. Mortgages have come down. They were at 7%. Now we're in the like 6.2% for 30-year mortgages. By the end of this year, if I was a betting person, I would probably call for, I wouldn't be surprised if we're seeing it drop another point in the low 5s or mid 5s, because I think as we get inflation under control, global investors are going to say, all right, America's getting it under control again. We'll go back into treasuries and that's going to affect things. So treasuries go to the beat of their own drum versus what the Fed is doing. That's just my take. And because if interest rates continue to drop, that's my reason for, I don't think we're falling another 15%. Next slide, please. So what we're seeing currently for multifamily, some of the factors of underwriting these projects, strong rent growth. I got a slide later, rent growth in 2021, 22, some of it was double digit in 20% range. So we will have strong rent growth. The occupancy is super low. I don't think we'll be doing 20% increases year over year. It's not sustainable, but we will have positive increases. There's lots of demand for real estate in San Diego, even with what's going on with interest rates and the Fed discount. There's tax advantages. People still want to have a piece of San Diego. Cap rates are still pretty low. We still see it in the low 4% range. I still saw one under 3 the other day. And really, I think it's a hedge that investors are doing to have some assets in San Diego. Let's see, what else can I say on that? Oh, the only problem that we're seeing in underwriting, which I think is a temporary problem, is the debt coverage ratio and the ability to cover your debt. I think that's a temporary thing. It'll last this year, and the banks just got to get more comfortable. Doug could probably talk more to this in Q&A about what he sees with debt coverage ratios and those types of pressures. But that's the one thing that we're seeing with our developer clients who want to build a project is the banks are saying you've got to cover that debt. And because interest rates are higher, it's caused projects to put a pause and to pause right now on development. Next slide, please. So this is some of our metrics on multifamily through, this is mid-year, but I need to change the slide. This is end of the year as well. So apartment deliveries, we may be at an apex. In 2023, we should be delivering about 5,600 apartment units. So those are projects that had already started construction late 2021, early 22. But what we've seen in 2022 is because of the underwriting problems, we've seen a step back because costs are still high. Nothing happened to cost, but your financing went way up. So developers are having a hard time making the numbers work. We're working with developers that are going back to the city for some workarounds on some of their restrictions that they're not allowed to do, to say, hey, this isn't feasible anymore. So it's slowing projects down. So I think what we'll see is 2023 will be an apex for apartment development deliveries. And 2024, 25, we'll see some lower numbers, not 5,600 units. We might see a couple thousand units because it'll be a pullback. So if you own multifamily, hold on to it. I think it's still good. It's not an underwriting where things are going to be repriced. If you've got income stream, I don't see anything going down here. It's a solid asset. Next slide, please. Touching on home building trends. This is for San Diego. This is the biggest challenge that we're starting to go around town and educate the planning departments and whatnot, but it's the type of housing that we're building. So if you remember, we're not building single family homes anymore. Basically, we're building 6,000 fewer single family homes. That's part of the problem. The other problem is we're also building about 2,200 fewer condos and townhomes. So if it's no single family homes and we're building less condos and townhomes, all we're building is apartments. There's no more of that starter home where you can buy a condo and you have a place to live. So much of what we're building, we're seeing is small, compact units. And that's what it could pencil. That's what's feasible to build in the region. And when you have a housing crisis of so many housing units that we need, and there's a shortage everywhere. So you just build whatever makes sense to build. Right now, what makes sense to build is apartments and build them really tiny. Next slide. This chart shows going back to, I can't read the small line. Thank you. Back to 99. This is the percentage of one bedrooms. I'm sorry. This is the percentage of total housing units built in the county that are what I call small units. So anything smaller than a 1-bedroom unit, 1 bedroom, a studio, and now we have this concept called a micro unit, which is basically a hotel room. The percentage of units that we're building as a total of all units in the county has nearly tripled. It used to be around 11%, 13%. Now we're at about 27, 29%. So the rate at which we're building has almost tripled. And that's because when developers build a project, they keep shrinking unit sizes to get the rents up on a per square foot basis because that's what pencils. So that's what we're building. So the question that kind of everybody should be thinking about is, if my kid decides to stay in San Diego and they want to move on and have a family, or they need more space, they need a second bedroom, maybe an office, they want to work at home, it doesn't exist. We're not building it. So what we're building in San Diego is what I call a temporary paradise. San Diego is a great place to live in your 20s, get out of college, live in a flat. And as soon as you want a family, as soon as you want to couple up, as soon as you need more space, you're moving to Raleigh-Durham. You're moving to Austin. You're moving to Las Vegas. This is kind of my tagline speech that I give every time I talk. Last time, 2 months ago, I said the same thing. Some young lady in the audience just started laughing. And I sat down next to her afterwards, and she said, I'm so sorry I laughed during your presentation. I didn't mean to, but I have to tell you, she says, last week I turned 30. I'm moving to Raleigh-Durham next week because I want to start a family. Next slide, please. I think this is my last one. I want to kind of touch on kind of big picture San Diego, what's going on. There's a CEO conundrum. I think I just touched on that, is how can we house the employees here? So if I have a business here, is this going to have long-term success for me, or do I need to move my business somewhere else? This is not a housing issue. We need to change this whole thing of a housing crisis. Years ago, I said, I don't like saying we have a housing crisis. In fact, we don't. My builder clients didn't want me to say that, obviously. But we don't have a housing crisis. We've been saying housing crisis ever since I entered the industry, which was in '98. To me, a crisis is something that should end at some point. I think we're just in an expensive housing market and it's not going to stop. So we will always be expensive. But this is a workforce and economic crisis. That's the crisis we're having, because if we can't create the housing, it's going to affect everybody's job and our ability as a region economically. We have two different models in San Diego. We've got Apple and Qualcomm. Qualcomm isn't expanding here anymore. They don't see it. They're going to other areas. They're focusing on Texas. That's where their expansions are. Then you have Apple, and Apple is doing 2 million square feet in Rancho Bernardo, wants to add 5,000 employees. It'll be interesting to see if they can get those 5,000 employees, because when they come to live here, I don't think their idea is I'll live in a micro unit down close to downtown. Some of them will have families, and let's face it, San Diego is about raising a family in kind of the suburban areas and school districts and whatnot. So there's two different models there. We don't know which one will play. Apple obviously is attracted, and Google is down here because San Diego is attractive and it's cheaper compared to the Bay Area. And so we are getting those interests. So it'll be interesting to see which one plays out in the long term. But we've got a lot of positive attributes in San Diego. UCSD, it's the number 10 public university, $164 billion each year in funding for research. We're the number 3 biotech market in the US. Companies, I already said that, they're moving here. So downtown is kind of a big litmus test going on right now to see how real this is. For years, we've wanted to see development and office development succeed in downtown San Diego. There's 3.3 million square feet under construction and planned right now in downtown San Diego. The biggest one is the RAD project, which is the big biotech. So we have the potential to add about 11,000 new office jobs in downtown San Diego, which I hope we do. That'll be, it's left to be seen, R&D jobs, how successful that is. But that's something to keep your eye on in the region. We do have an office hangover from COVID. It's still here. We probably overbuilt office. No, we didn't overbuild office. We have a 20% excess capacity in the region and nationally because of the downsizing of office after COVID. And that's part of the problem of what do we do with some of these assets? Should we repurpose them? A lot of it has to do with the class B and C space. Class A was generally okay, especially in the gateway markets, because class A space goes on sale, everybody moves it into there. So it's the more, the other assets that are having trouble. Boutique economy. Ultimately, one outcome of our challenges to growth is maybe we're done growing. Do we just keep adding housing? I mean, we're out of land. Or what does that look like? Or do we become more of a Santa Barbara where obviously we're much bigger than Santa Barbara, but it's pretty much self-contained and they operate the way they operate. I could see San Diego go on that model too, versus just keep growing and growing and stuffing and everything, because it's hard to keep growing if we don't have the ability to do so land-wise. So the question is, how can we sustain this, a sustainable economy? And that's all these points that I want to bring up. Is there's a lot of challenges in San Diego. For those that own real estate assets, they're all positive attributes because the barriers to entry and investment are super high. I don't see any reason for more vacancy or rental rate decreases unless you're holding older office. You probably are already experiencing that. For hotel projects, the more luxury ones, the ones that are dependent on corporate business, we've seen some softening there because the corporate business has slowed down a little bit. It recovered in 2020, late last quarter, but it's starting to soften again. The leisure market, especially in hospitality, is strong. I don't see that going away. So the mid-market hotels for kind of your core leisure, we see a strong market there. And I think that may be my last slide. It is. I hope I didn't go over. I'm sorry if I did, but we'll be available for comments. Thank you.
Good morning, everyone. Well, this is a tough act to follow. Good news, bad news. My name is Brett Albrecht. I'm the president of Kramer Land Company. We are a private equity family office, North Orange County and Las Vegas, with offices to be expanded into Arizona, hopefully shortly. Kind of fun facts about our group that's a lot of folks find interesting is, number one, we're not a small family office by any means. In fact, I've yet to meet, and I work with a lot of different family offices regularly. We have 145 family members in this group, and we're on G7, working on G8, which is also something rather rare. Usually by the time you get to G2, G3, things, the wheels start to fall off and there goes the company. I think it's important, and everything you've heard today, I'm going to bring it together and I'm going to present it to you in the lens of private equity. And I want to be very clear that we are private equity, 100% discretionary with our own balance sheet funds. That's different than a syndicator. Syndicators are, I don't want to use the bad term salesperson, but syndicators have one job. That's to get money out the door for a fee. That's their job. They raise capital and they have to place the capital. If you don't place the capital, you'll never raise another nickel again. So there's a dichotomy. There's a pressure to get money out the door as a syndicator. And sometimes, and I'm speaking from knowledge, I came from the institutional side of real estate. We took advantage and understood the game that we have a job to do, and that's to underwrite real estate. And sometimes you look the other way when you see things you don't like, because your job is to get money out the door. It's a very, and Doug will be the first one to tell you, that's a very dangerous conversation to have. So the lens that I'm going to present to you today is, what does the private equity groups look like? And in our sense, we are the complete capital stack. And what I mean by that is, we're not just on the equity side. We're on the joint venture equity side, but we're also on the debt side. We are a debt provider. And to something that Doug talked about was the Dodd-Frank regulations. We're private. I'm not a bank. I don't have a regulatory compliance group sitting in my board or in my office. We are a real estate development group that understands how to write real estate and provide debt and securitize that. And oftentimes we've had great success when, up until probably 2021, when construction was going strong. We were a construction lender at that time, and very robust business, because as a private lender itself, we could go from term sheet to loan docs in 30 days. And we had regional banks coming to us, literally coming into our office saying, first of all, you're killing us, because they can't do that. A typical regional bank is going to underwrite the sponsor first. They're going to underwrite the credit first, and they're going to spend 8 months looking at everything they can, including your operating agreements and looking in all the wrong places just to comply with the regulators. And eventually, the last thing they look at is the real estate. We're a real estate development group. We're a land company. What's the worst thing that happens on a loan if they don't pay? You foreclose. So we're a land company. I don't mind having land on our balance sheet. That's the worst. That's the last thing a bank wants. So the prism that we're going to look at is, we do both commercial as well as residential development. On the commercial side, it's office, industrial, and retail. I'm not a multifamily guy. I'm not a hospitality guy, so I really can't speak knowledgeably to those. But I want to talk about what is actually happening in the field. What's happening? This is a non-academic exercise. This is real life. What's we're seeing on the street right now. And we can go to the, should have moved the slides. Just a little bit of the other history itself. We're very active. We're quiet because we're private, but we've done over $1 billion worth of transactions since 2005. In all three of those categories, as well as the residential development, as well as commercial. Go to the next slide. So what are we seeing right now? Despite in the news media, a lot of the commentary that we're hearing right now, and this may be helpful with some of your clients itself, but there's a reality that we're in right now. And that is, I'll call it the great movie called The Dead Zone. Why is it a dead zone? And I'm speaking really from the land development standpoint. We're the starter, but it does emanate into other classes of real estate itself. The dead zone is, there's no equity. The equity's on the sidelines. It's a chasm. We're in a vacuum right now. On the other side of that, we do have sellers. They're a little late to the dance and they have unrealistic expectations. So I'll give you the example. I was thinking about this on the drive down this morning. It's kind of like that guy standing outside of Petco and he's got that $1,000 ticket that's right behind home plate in the club level. And he's waving it around and this is the land sellers, by the way. And the problem is the game's over. And everyone's walking by him and you can wave that ticket all but there's nothing transacting. Now this is short term. And again, this is not Armageddon, but this is the reality that we probably have between now and fourth quarter of this year. Fourth quarter, we're going to pick our heads up, look around, reassess and see where we are. But for right now, that's the vacuum. Now I'm going to take that same example and make it even worse. So I'll tell you what the lenders are doing. So let's assume there is a guy that's willing to buy that ticket for $1,000, but he goes, hold on a second, I need to borrow $700 from my buddy. You're not going to get that. Your buddy's going to tell you you're nuts and go away. So the lenders are out of the market right now. The capital is out of the marketplace right now on the residential development side. And that's, again, we're both on commercial as well as residential. We see the dramatic effects more on residential development. And to Nathan's point, it's compounding a problem. And that is the public builders are completely out of the market. And I don't mean they're just not building or buying, transacting new land or talking to us about lots that we've developed. They're walking away from substantial land transactions, walking away from millions of dollars of deposits as we sit here right now. Shea Homes, Toll Brothers, Lennar, you can name any one of the biggest builders out there are not just out of the market, but they're also taking a hit on their way out. That says something, but it's not sustainable. You cannot continue to do that. That just means right now the capital markets are not going to react favorably. They're pulling out of transactions. They're cutting their losses. And by the way, California, I think Nathan was nice. There's a lot of things wrong with California and doing real estate development in California. And that also weighs in on some of these public builders to saying, I can't take on this risk right now. But it's not going to last forever. So again, I'm giving you some bad news and it's gloomy right now, but that also leads to some opportunities down the road. Spec construction on the commercial side, forget it. Unless you're going to build it for cash, you have a piece of land and you want to go build your dream industrial building or forget office. That's long gone. There is no market for that. But the one glimmer of hope that we do have, and I'm very bullish and I have always been bullish. I grew up in this business back in the 80s, developing industrial real estate, and we're seeing those fundamentals still stay strong. We're going to see some pullback on industrial, but the fundamentals right now, and I'll just leave you with this analogy. And when I say industrial, I really mean light industrial distribution, not manufacturing or heavy industrial. And at the end of the day, with the e-commerce component that we have, that emanates through so many different sectors that the distribution itself, I can't email a part. I can't email an engine. I can't email a product. That product has to ship somewhere. I'm going to go deviate off. And if I run long, you just throw something at me. There was recently just a report talking about what has happened during this pandemic. Well, what happened when we look at the greater industrial LA basin, extends from Long Beach, LA, all the way out to the Inland Empire. During the pandemic, we saw vacancy rates go less than 1%. Now, I've been in industrial real estate 35 years. I've never in my life seen anything like that. When I speak to colleges and universities, we use this term, anything less than 5% vacancy is an unhealthy vacancy. And I never really gave it much thought. Less than 1%, that's unprecedented. And it creates stress in a market, both on the landlord side, but also on the user side. Users can't find space. Landlords are at risk of becoming a dying dinosaur as what's going to happen. The market's going to react and it's going to squirt. It's going to squirt to Vegas. It's going to squirt to Phoenix. It's going to squirt to Salt Lake City. And all of a sudden, the market that you once enjoyed and was encapsulated, you're making it worthwhile for everybody to find an alternative. So it's a little risky. But something else happened during the pandemic, and I'm sure you guys have all heard the reports where we had cargo ships parked offshore past Catalina. They couldn't get the cargo off the ships. So think about this. We've got a condition in the greater LA basin, and we're talking billions of square feet of distribution space, less than 1%. Can't get the cargo off the ships. And now flip the light switch that just happened. And now we've got a cool down in the economy. In the month of October, the Port of LA just recorded a record number of cargo containers that they were able to offload, 550,000 containers, never been done before. Uh-oh. Now you've got the cargo coming off the ships. You've got slowdown in the economy. You've got goods sitting on shelves at Home Depot, Best Buy, Kmart, whatever, and there's no place to put it. So again, I'm bullish on industrial for lots of reasons. That's one of them. I could spend a whole 2 hours and give a seminar as to why you should own real or industrial in your portfolio. Next slide. So what are some of these things going to happen? And I think I'm optimistic personally on land. Land is always a very cyclical component of any portfolio. It's really, people ask me all the time, hey, what's my land worth? That's a loaded question because there's so many components. It's really, in my opinion, it's a residual calculation. It's a residual after you pay for everything. If it was a finished value of X, what did it cost to build it? What were my directs, my indirects? Then what was my cost to develop the land? Including not just my on-site development costs, but also my off-sites. And when you do that math, sometimes land's worth zero. And we saw that in 2008. We saw where we could buy tentative maps at $3,500, $4,000 a lot. Now, bear in mind, it was probably took $25,000 a lot just to put the entitlements in place. So what that translates to as an investor, as a land developer, I can buy a tentative map for pennies on the dollar of the entitlement costs, and I really get the dirt for free. That's a dynamic that not a lot of people understand in the cyclical world of real estate development itself. But what are we going to also see? We're seeing lease rates slide. Office is your number one component. We are seeing a complete correction in the office market. Retail's taking a hit as well. Industrial is holding firm for now. I don't know by the end of the year if we're going to still see that or not. I'm already getting phone calls on non-performing loans. Doug's phone's ringing right now in preparation of it. What alarmed me the other day is I took a phone call actually on an industrial building in the Inland Empire, non-performing. Lender is looking to privately sell that to us. And that was not a sector. Now, we're not going to transact on it, but I did pull my group together and say, this is significant. I have not had this phone call in 12 years. It's starting. So again, this is the doom, but there is a light at the end of that tunnel itself. Debt and equity will remain very selective as we move forward. We can go to the next slide. What do you do if you have clients that are in various asset classes? What are some things that we recommend, some things that we employ ourselves itself? Is right now, this is not a seller's market. If you don't have a seller circumstance, if you don't have a loan to resolve, if you don't have a tax issue in a state to resolve, if there's not a compelling reason to become a seller, just because you missed the last cycle doesn't mean you should be a seller right now. Just in my humble opinion, if you can stay the course, stay the course. Stay in the marketplace, keep your ear to the ground, keep your capital dry, because again, this is cyclical. This is today, but it gets better. And I think there's going to be some really interesting opportunities moving forward. If you have existing, I don't care what asset class it is, whatever the building is, if you have the cash flow to maintain, stay current on your deferred maintenance, don't let the properties go. This is not the time to do that. It's going to be a very competitive leasing market across the board. As lease rates are sliding, you're going to shorten lease terms. This is not the time to tie in a low lease term for 10 years. That's too long to live with it. Have the opportunity to catch them out the market as it comes back itself. And also on lease structures, something I saw, and I worked with some family offices back in 2008, 2009, where they were preemptively going out and reducing lease rates of their existing tenant base 20%. Oh my God, don't do that. It's an interesting theory. I watched it play out and it had horrible results. You deal with it on a case by case basis, and the folks that are in need that have a saleable and an ongoing concern, work with them. If not, if they're a BK waiting to happen, why would you reduce anything? They're going to go out on you, whether you reduce their lease rate or not. That's just be careful with it. Also, as valuations correct, I'm sure there's a lot of trust valuations here. This is a time that we take advantage of looking at, is there an increase in minority interest discounts? Is there any other discounts that we can take if we're going to have the transfer of ownership of real estate? Let's go to the next slide. Here are some of the things that we are going to be looking for. We are seeing already in a tentative track map, that's the TTM. We also call those paper lots, meaning they only exist on paper. There's no addresses, there's no specific APN numbers, and both on commercial, but also on industrial, or I'm sorry, residential itself. Those are just, that's the first step. In California, you do your tentative map, and then you also pursue a final map. Both of these zones, I believe, on the single family detached residential are going to be very, very interesting. Non-performing note sales. I think there's some great opportunities. I just took a call yesterday. It was a group looking to not only take out and refinance their maturing note, but of course they want to pull out another $1 million, very small transaction. A little greedy in this marketplace. So instead of trying to transact and be a lender in that traditional sense and give them their wish list and give them not only enough proceeds to pay off their note, but also take out another $1 million, how about we just contact the lender and see if he'll sell that note? And we'll just go in the back door that way. The seller circumstances is something that we have not seen in the last 10 years. Why? Because the market corrects it. If you have a divorce, if you have a tax issue, and you need to liquidate real estate, you put a for sale sign on it, and chances are you're going to transact. There was no discount to your seller circumstance. Now with this equity as well as debt disconnect, those circumstances are going to emerge, and they're already coming out. And keep an eye out for, I don't care what asset class you're in, you'll see that happen. Leverage your expertise, and across the board, all of these things are work with professionals. And one of the things I put on a different slide is stay in your lane. This is not maybe the time, and I never recommend, unless you are an expert in hospitality, I'm not sure this is a good time to become a newbie in hospitality, or land development, or residential development, or industrial. But there are folks out there that you can work with and partner with that are. And that sharing of resource is probably more important. We'll go to the next slide. And I think that did I make it on time? Thank you very much for everyone. I really appreciate your time.
Well, I hope everyone found that interesting and informative. We have some time for Q&A. I mean, this is really the balance, candidly, I was hoping for, because I have this more of a macro view, and I can tell you some stories I think you'd find very entertaining, and I'll share one in a moment about Nathan talking about office in downtown and some of the realities we're seeing that are rather compelling. And Nathan, I think his whole presentation with respect to housing is on point. There is not enough of it, and it's hard to do. I thought Brett's comments were absolutely what we were hoping for, because he's talking about real life in these trenches. And, you know, the one thing I learned an expression 35, 40 years ago called buy your straw hats in the winter. You know, take advantage of those opportunities, stay liquid. This is when there's great opportunity in these markets that have struggles. But it's also naive to think that everyone's, you know, just can sail through some of the challenges we are dealing with. And so I think that, you know, I'd like to make one comment about the market office wise, because we focused on that a little bit. I think and we're going to circle this back to San Diego, because this is clearly a tale of two cities. My roots were in building high-rise office. We have taken over tens of millions of feet of office. Our phone is ringing off the hook. Let's take downtown San Diego. Downtown San Diego today's got a vacancy, if you'll know this, that is in the mid-20s at least. When you combine, when you put sublease space on top of that, and that shadow space is probably 30, low 30s. You have 2.5 million feet of new space downtown. I'm a developer, I've been there. I drive by IQHQ, 1.8 million feet, no tenants. Stockdale redeveloping Horton Plaza, 750,000 feet. A year and a half late, stopped construction for 3 months, had to recapitalize over a year ago, no tenants. Okay. Kilroy's got a project, an #1 developer in the country, 250,000 feet, right there on Kettner, no tenants. If you factor that into, there's a building that was bought on Broadway corridor. It was bought as an existing building, the old executive building. They reskinned it, redid it, kicked out all the tenants, have a basis now of over $100 million, no tenants. So there is a probability that a year from now, when all these come on and all are CO'd, certificate of occupancy, we could have a 40% vacancy downtown. This isn't Doug Wilson speaking. This is CBRE. It's this gentleman. Okay. It's everybody that's in the business. And we are meeting now and have been for some time with all the top brokers in the region. Now, a tale of two cities, UTC, Northern Cal, and this is wonderful. This is wonderful. It's done remarkably well. The whole notion of downtown and life sciences, which we fully supported. And I live downtown. I'm a downtown guy. That's where I've been. And think the architecture is stunning. Want big tenants to move there. No question about it. But the fact of the matter is that bet hasn't paid off yet because these life science tenants are moving on the 56 corridor. And they're up here by UCSD where all their friends and family are. And so again, I am not for any moment saying Armageddon, but I'm saying those are compelling facts where these projects, these owners are out of the money. There is no equity. At some point, these buildings have to be recalibrated. Okay. And so on top of that, you have UTC that's doing remarkably well. So anyway, again, we could go on and on with all these stories. At the end of the day, you know, it's really about all of you and all of your clients, and any of us are here to assist or provide any insights you'd like. So with that, I think we are out of time. Oh, we can go. Well, then let's do that. Then let's have some questions. I think that would be great. And please go ahead. Yeah. Yeah.
Secondly, we're seeing apartments in Texas, Florida, Mid-Atlantic exploding. Are the comments we heard today relegated to homes, or is it a different story than apartments for San Diego specifically, but California?
Repeat the question as you go for those.
Yeah, I mean, it's a difficult question. It's kind of a macro question, or, you know, some of the, I mean, we're certain trends in California, you know, people migrating out and the like, and a boom in some of these other markets, Texas and elsewhere, people are going to and impacting those real estate markets. You know, that's a tough one. I'll give my sense of it, and I love, Nathan, your thought of that as well. You know, I hear about this. I know that. I have friends that do that. I understand that. But if you see what Nathan projected on the residential side, still a lot of people still want to be here, like it or not. And it is a pain in the ass, pardon me, that's a business term. It is difficult to buy land, get it entitled. I've done that. I've done all of this in my career. It is a struggle. If you can actually do it successfully and hold on to it, great value. But the state is not making it easy. The cities are not making it easy. The counties aren't making it easy. We had a building, we bought 50 acres as a principal about 5-6 years ago, thinking we would get it redeveloped through the county. It may be 2.5 years. It took us 4 years and another $1 million, just because of, and we kind of know what we're doing. So I don't have the answer, but there still are a whole lot of people who want to be here because they aren't making that anymore. That view. And so, but Nathan, I'd love your take on that.
Yeah, I'll elaborate. I think there's two reasons why the trend will not reverse. One is the young people are moving out of state and they'll live in an apartment because of cost of living. The rents are so high here, there's not much to do anything else. Number two, they're moving out not only because of the cost of living, but because they have a move up housing market. You'll be able to save some money and then buy a house. And I get all this because a lot of my students leave the state after they graduate UC San Diego because they do that math and say, I'd have to have a roommate and I spend all this and I won't be able to save. So they're looking for jobs elsewhere. So if you follow the demographic growth of where the millennials are going and now the Gen Zs getting out of college and whatnot, they're moving to those hotbeds and that's where the jobs are. And it's all about how much the quality of life and the affordability of life. So I don't think that's going to reverse. It's a problem we're going to have to deal with.
Yes.
Did I say, what about the treasuries? No, they went up to, our treasury rate's going to be up. When treasuries went up with the Fed's actions and inflation, it went up to about 4.2%. It's dropped down to about 3.5, 3.6. It's kind of hovering around there. I think in a year from now, it'll be a little bit lower. If we get inflation under control and the narrative changes in all the headlines, then you'll see them drop a little bit more with interest rates. Now that without standing any existential event or if inflation still is rampant, then these comments don't apply.
You know,
what do I think the permanent level is then? Oh, I don't know what I wrote on there for permanently.
you know, I'd like to have a comment about, rates for a moment, because we're asked this all the time. And he's talking about in the residential world, I understand that, but if I'm going to go out and get a commercial loan, they're going to peg it to bank rates or, other terms of rates. And people think, oh, inflation's slowing down, which it is. And therefore the Fed's going to start to lower rates the end of this year. That is completely naive. That's not going to happen. These rates are at a point where they're going to be stabilized at point. I'm betting they're going to raise them again, and they'll probably stabilize at that level. And I don't think they have any plans to lower these rates into the foreseeable future, because we need to balance. We need to have this equilibrium. We need to have this readjustment work its way through the process. And so, but again, that's a different dynamic than borrowing money to buy a house. So, yes.
Here. Okay, I read in the paper recently that the transit districts are going to have all this land available to create housing so that people can live right next to the train station or, rail, whatever. So are they going to reduce restrictions to development so that the housing can get up there? Because people now are going, I don't want any more housing. They vote against all these real estate developers. Thank you.
Is the availability of land in a transit district going to be assisted, if I may say that, by lower regulation and lower restrictions for that development? And the answer is no. We live in California. There was a governor, not very well-known governor back in the 60s named Ronald Reagan. He enacted this thing called CEQA, and CEQA is the California Environmental Quality Act. That is a statewide initiative, and then it's adopted in every city within California has to abide by that. But not only that, but to make matters worse, and again, Reagan had no intent of this becoming what it is. It's also been hijacked. It's been hijacked by, I'll use the term, false environmentalists that want to shake down developers. And so those restrictions itself, until somebody fixes this in Sacramento, and until we have sweeping CEQA reform, those restrictions are going to be there that we're going to have to live with.
Yes.
Curious, kind of in line with this comment, we're hearing about this 4-cent tax on driving. Does that happen? I know that Sandag's pushing it. There's a big contest between the county, the cities in the county and the city of San Diego in terms of the voting structure. The question is, does that have a chance to pass?
I don't think so. I don't hear a lot about it, frankly. I mean, I would be curious about your comments. There's a lot of discussion, but I don't hear a lot about it.
Yeah, I don't think so, especially since Sandag already pulled back on the mileage tax. I don't see anything that's going to be tied to this additional tax to fund transit. It's already getting a lot of pushback.
Right. That's what I agree. Yes.
One of the things that happened during the COVID was government put restrictions on evictions that still exists in LA County. I was wondering, between the three of you, do you think it was legal, and what has been the effect of that on landlords? Can't evict in LA County.
Well, I long since gave up practicing law, since I've never had a business class, let alone a law class. However, it clearly had an impact. I mean, there's no question. I was unaware that LA had still not released. I knew that they were lingering. I thought, okay, I did not realize it was to that extent. Clearly, so I don't know about the legality. The impact is clear.
Anything down here, any of the government people you're talking about, are they talking about it like that? Or that was a great idea? Not that I know.
I don't think so. I don't think so. I've heard nothing about that here. I mean, the big push here is to build more housing, and then you talked about this infill housing, and there have been a lot of changes made to facilitate that. But there's a lot of pushback on various issues too. Yes.
You gotta change the way that we plan in the state of California, because right now we're not allowed to go further out. It's all about the greenhouse gas studies, because any type of project you have to do, you have to offset and minimize your greenhouse gases. So the further you go out, the more gases you pollute. And so you're not allowed to develop it. There's no way to offset it. So that's why everything's on the infill. So it would have to be at the state level to redo how we look at those technical studies to allow that development to happen. You're saying the exact argument that I've always said too. Are we even taking into that account? Because you're right. When we're all electric cars, who cares about the GHG? We should be able to live wherever we want because you're not emitting anything. But it doesn't, we're not looking at that right now. It doesn't offset anything.
Yes.
Nathan, you mentioned a multi-family cap rate that was below 3 or something that effect as a hedge. Can you elaborate on that in terms of the relationship between cap rates and 10-year treasuries, and what does keep that low?
Yeah, initially I was thinking cap rates, we were gonna, and we've talked about this, Doug, that cap rates would increase because the spread on cap rates over treasuries, that's how it's always looked at. But multifamily is its own animal. When you have 2% or less vacancy rate and rents are going up 20% a year, that's the hedge. Is I'd rather buy this property or 1031 into this property, defer my taxes because I see rents still going up. Even if it's not 20%, if I could still be making 5, 6%, 7% on rents increasing year after year, I think that's the play that people are making. And I don't know, Doug, if you have.
Well, I think multifamily is an anomaly. It's an asset class out there. It's like its own species, because of those dynamics and the supply demand. It's the other assets that, you're wondering where do those cap rates really wind up today because of some of these adjustments and unknown in the market. That's really what we're seeing. So where are those cap rates? I mean, they've been moving and, that's, but I would have said, multifamily is its own species and industrial to an extent as well. Yes.
Recognizing the supply dynamics that Mr. Moeder detailed.
He'll always be Moeder to me.
As a mitigant, parent skepticism, whenever I hear this is sort of different species, different time, sort of hackles come up. How are there not limits
to, based on affordability, really, it's the primary driver. Those increases, those rate increases, you've seen at such an historical, maybe unprecedented extreme, 20% year over year rent increases. Doesn't that imply some significant potential downside that we may be at extreme peak in this cycle?
So two things, the 20% increases, a lot of it is the older market catching up. When you talk about the newer construction stuff built in the last 5 years, that's not going up 20% a year. That they're doing, some of them are flat at the luxury market, or they're just going up a typical 3% on renewals or something. So a lot of it is the bottom end market that's being rehabbed, or they're increasing their rates there. That's where that inventory is coming from. There is softening in the residential market in some areas. Downtown San Diego, the problems we've seen is the ultra luxury stuff where it's $5,000 for a 2-bedroom apartment. They're having trouble. They're sitting longer. And so the rates are not increasing. Now they're not coming down a lot, but there is some softening, but most of it is at the very high end luxury side. So the 20%, yes, it's not sustainable, but we've been saying that for years. So if anything, it would be flat. And so when in underwriting these types of assets, I think last year we were working on deals and people were putting in 4 or 5% inflation into their rents, and now they're back to the 3 and 2%. So if you're underwriting these assets, I'd probably put in at 2% and keep it flat just to make sure that there's some extra give there.
I will make a global comment about what you just said, because I happen to believe that fully. I mean, if people think, everything goes up forever, I don't care what some of these dynamics might be. That's naive, because things happen. I mean, there could be an external event. Who knows that could happen that could readjust these markets. When I left Denver many, many years ago, that energy collapse was remarkable. I mean, it was just remarkable how it impacted all of Texas, the Western United States. 5 years before, it was a feeding frenzy. It'll never happen here. So I'm just always one to say, let's always be cautious. Let's always say not ever, and just keep our eyes wide open. So I think your point is, final question.
You touched on the demographics, and what I'm seeing around the county is a lot of retirement homes being built, and these seniors are taking their cash and going in there. What's your view on that?
Well, I'll address that, because I developed one about 4 or 5 years ago, assisted living memory care. I know that space. And we sold that for various reasons about 3 years ago. But I'm also the workout guy, and as a receiver, I am waiting. I've been approached by 2 senior projects. There's one that they have put me up to be the receiver. It's a fairly new assisted living and memory care facility. It's only 3.5 years old in San Diego, in North County, that was interimly financed, like with construction financing, bridge debt, no permanent financing. And now they're completely upside down because they're only 30% leased. Okay. So that is a tale of 2 cities. And so there is clearly, because that space has had challenges. They've had challenges getting help, the cost of getting help. There are a lot of external factors that have really impacted. The pandemic was not helpful. And so, it's, I thought people just getting older so they'd fill them up. That was my theory until I gave up on that theory and moved on. Anyway, with that, we're done.
Thanks so much, Doug, Nathan, Brett. Really appreciate it. For the insights are flying in, detailed economic analysis, real life guide, trying to juggle the whole thing, and Doug at the biggest of pictures. But thank you so much for coming. March 7th is our next meeting, which is what the estate planners can learn from the estate litigators and administrators. So look forward to seeing you there. Put your cards in the bowl and join us for our trifectas. Good way to get to know each other better. And we'll see you then. Thanks.